Morning, everyone. Marty Missouri here. It is Thursday, the 20th of March, 2025, with your end of week message. I'm kind of in the mood to get that message out to you, although you may not receive it till Friday morning, but just kind of feeling it this morning. There's no major economic data coming out tomorrow that would impact the score of our own economic index, so I'm free to kind of do this for you here this morning. And I'm not going to take very long. I really want to focus more on the market and on the technicals, the equity markets in particular, but we'll do the usual and look at others as well. And I'll start as usual with sharing some of my notes with you and kind of give you the gist of what we're thinking, and then kind of a message to clients about our year-to-date results and our core portfolio and what our expectations or concerns are going forward. So I just copied and pasted a note from Peter Bookvar this morning that, as I say here, makes the point that we've been arguing, and that is the rotation out of largely foreign-owned U.S. equities. I think that's not small in terms of the decline we've seen in the dollar of late. And he has been arguing that point as well, specifically with the Magnificent Seven stocks that have really dominated the returns in the S&P 500 the last few years. And again, specifically the holding of them by foreigners. A friend of his posted a chart highlighting the extent to which foreigners own U.S. stocks. The dominance of the Mag 7/AI Tech trade is over in his view, and has possible repercussions for the U.S. dollar. Again, point that we were making about the dollar. Also, if the administration is successful in reducing the trade deficit, whether that's a good idea or not, foreigners will have less money to invest in the U.S. as they accumulate less dollars. Clients, those of you who we've had these discussions, I've often said, and you've heard me say it over and over again over the years, that one of the benefits, if you will, and you can put air quotes around that if you like, is that when we deposit more U.S. dollars out into the world economy via the trade deficit, those dollars come back in our capital account, and they show up as a capital account surplus. And they are not small. In fact, I would say they are massive in terms of what they have done for the U.S. equity market that folks have enjoyed in their 401k and so forth. So just know, and I keep making these points, I'm not judging them politically or otherwise, the policies that are unfolding. It's just that for example, Secretary Bessent said there's going to be a detox period. That's essentially what I'm talking about. If they are going to cut the size of government, and if we're going to have a massive impact or an impact on trade relations to the extent that it lowers the trade deficit, there is a negative as it relates to the capital account in the U.S., and that translates to the price of assets that a lot of people in the U.S. own. Okay, also in my notes here, chip stocks, chip equipment makers, I said here their best days may be behind them. We do have a position still, small position in a chip equipment maker, but and we're keeping a close eye on that. But this is from MRB Partners, and they talk about the peak in sales momentum that's currently going on, and they point to other peaks. Remember, this was the 2022, which was a 27% peak to trough decline in the market. 2018 saw two separate declines, 10 and 20% respectively. And in 2016, we had about a 15% correction. I'm just translating this to equity markets. So here we are at a very, very high level, relative stock prices, and then you can see the rolling over of the 12-month forward earnings projections. Forward sales projections are peaking, and semiconductor sales look like they're beginning to roll over. Plus, and this is a point that we've been making a lot, is that the valuations remain very suspect. Here is still the forward PE ratio, and you can see where it was when the market peaked in 2022 relative to the broad market. Price to sales, that's the last time it peaked, and so on. Homebuilder sentiment, as of the last reading, which just came out this week for March, fell to a very low 39. Below 50 denotes contraction. And of particular, the note on the demand side was the 24 print for prospective buyers traffic, exceptionally low. However, I heard this morning that existing home sales actually beat expectations, so go figure. Where tariffs can have a longer-term impact, of course, is the price of construction, etc. Remember last video I said the market is oversold and due for a bounce. This is just me sharing Bespoke Investment Group's sympathy for that notion. And they go through, Fibonacci retracements, which we do from time to time, and so on. It's a technical market bounce. And as I said in the midweek note, that could bleed through for days, even weeks. It would make a lot of sense to me. So probably a lot more I could ramble on about global affairs and economics. But just in terms of the technicals, so let's just go to that quickly. So with the S&P 500, remember we looked at that back in here. I showed you that it was oversold, pointed out the 200-day moving average, and said that a retest of that is highly normal. It'd be highly unusual if we don't get a retest of that, even if indeed this thing is going to go, much lower. And so that's the blue line there, would be the 200-day moving average. So this rally that we've had so far makes perfect sense, technically speaking. Now, what it also looks like, folks, and you can see this vividly, is your most classic bear flag. And that size of the flag itself relative to the pole, if indeed that's what's going to play out, puts it right there at that 200-day moving average. If investors who were crying the blues here, who didn't get out, who are looking for an opportunity, technically that 200-day moving average, barring any good news, probably geopolitical news, I'd be surprised if we don't see the market hit that and then see some sort of a decline. Now, it could bounce along that for quite some time, but ultimately, if the bear flag plays out, then of course, you go down the length of the flagpole, right? And that's going to take the S&P quite a bit further. And again, these are patterns to be respected, as you know. But, they don't always, here we are again, right? They don't always play out, though. You see how this one didn't play out, right? And this one didn't play out. So even if it's 50-50, it's something that we need to be very, very cognizant of. But again, we're long-term investors, and we've allocated accordingly relative to where we think the risk-reward setups best dictate. With regard to the momentum indicators, it does support the short-term move, right? We're coming off the bottom here on the MACD. That's about to give you a buy signal. Of course, we look more at the slopes. Coming off of oversold territory, still way down there by other metrics. The market is still oversold, even though we've gotten this bounce right here. As for the daily chart of the NASDAQ 100 ETF that we track, quite a ways to go before we hit that 200-day moving average. But basically, it's the same look. The 20-day rolling over hard is not a good sign. And the 50-day rolling over is a really bad sign. By the way, that's also on the previous chart, the rolling over of the 50-day moving average. In terms of the momentum, pretty much the same look as we had with the S&P 500. The dollar, remember I said in here we could see a rally in the dollar. We're getting a little bit of that right now, coming off of oversold territory. Ultimately, a strong dollar right here, what it might denote probably won't be good for stocks if it continues, but that remains to be seen. As for yields, we do have a bear flag pattern here. We did break below it here. We'll see how low they go. You would think that if yields go down like they are today and yesterday, and this is all about the Fed kind of sounding dovish, I would argue that if you look at the dot plots, which is the projections that they do anonymously, even though the statement was what it was and they said there's going to be 2 cuts this year, there seems to be a lot less appetite for that among the players on the Federal Open Market Committee. But that was not mentioned in the media, which was quite interesting to me. So I'm not sure the market really got the message of the underlying details, but we'll see. Anyway, so if we do see that, typically what folks have grown accustomed to is, well, lower yields mean higher stock prices. You see yields do this, that means the economy is cracking, quite frankly, I think. And so I don't know that you want that to play out. It'll work well, obviously, for our bond fund, or for our bond ETF exposure. And then gold. Remember right here, I said gold looks like a technical mess to me, and then here we go, boom, up to new all-time highs. You sure don't want an island reversal pattern. That is where you have a gap, and then if we gap down here, that's a real bearish pattern. We are big fans of gold over the long run, cautious on it on the short run. We are hedging against a big, ginormous decline in gold, which, we could see. I mean, it's done really, really well, and it's been a good position for us. I'm featuring today the FEZ, which is the Euro Stoxx 50 ETF, which we own, which has been exceptionally good for us this year. You can see it looks like it's topping out here a bit, and it's gapped down lower today. Central bank news that the market didn't find as favorable, concerns about tariffs and things showing up. But losing momentum here, getting a sell signal, and coming off of overbought territory. So while the U.S. market was oversold, the European market, for example, was overbought. Now, folks, lastly, and this will be my closing message, those of you who are fully allocated to our core, I distinguish those of you because there are a lot of you who have come to us with what we call legacy positions, or we've had positions for a very long time in your accounts, typically U.S. technology positions that have huge capital gains unrealized. So that's helped you in terms of a reluctance to pay a bunch of tax all at once until this year, right? You're still doing fine. I don't think we have a client who's in the red this year, even though U.S. stocks are in the red. But those of you who have legacy positions don't have quite the positive results year to date compared to those of you who have just simply the core positions. If you are a nonprofit organization or you are an individual with a retirement plan, you would be the people that just have the core. Those of you that have traditional brokerage accounts with technology stocks in them that we don't want to pay massive capital gains taxes on right now, you've had a good relative year so far. It just hasn't been what the core has been. Because of that extra tech exposure, tech has taken quite the hit so far this year, particularly lately, up until the last couple of days. So anyway, having said that, what explains our core outperformance? Well, things like gold, which I just showed you, which is not a small position for us overall, and non-U.S. equities, particularly the Eurozone. Our Latin American exposure has done well as well. Now, I keep making the point that non-U.S. stocks are historically cheap relative to U.S. stocks. In some cases, different phase of the economic cycle, different incentive to stimulate the economy or the ability to do that from a fiscal standpoint in Europe in particular, Germany in particular. So those themes are still there. It's just that they've been largely expressed here lately. And so we have a day like today where the U.S. market is coming back, still, I think, just simply working out of this oversold condition. And we're basically flat, down 10 basis points because of gold taking a hit, European stocks trading lower, and so forth. Again, we're making money on the U.S. side of things. So anyway, folks, those of you who are looking at your stuff every day who are just curious as to how come you're hearing all this bad news and you've been holding up, it's because you have a macro-based, globally diversified, I'd like to think all-weather portfolio in these conditions. However, there's nothing that we should be taking for granted. Investing means accepting volatility. The way we do it is that we do not constrain ourselves to any one market in any one country, and we make long-term bets based on what we think are long-term risk-reward setups and live with the volatility along the way. However, when we think something that we really like is getting extended and the technicals look a little sketchy, like in Europe right here and in gold, we will step in and hedge with options. And we're doing that right now, by the way, with our European exposure and our gold exposure, as well as like we've been doing for the last few years with the U.S. exposure. So while your portfolio will feel it if these things take a dramatic drop, we have put insurance underneath them so they will not be devastating and we will not give up all of the gains that we've realized here of late. But definitely you'll notice it if indeed they roll over hard. And of course, all of that remains to be seen. But just know, clients, that the news can be very, disturbing, of course, as we go, and we won't be immune to all that volatility. So far, so good this year, and we will continue to work very hard at growing, preserving, and protecting your hard-earned wealth. Folks, thank you, as always, for watching and listening. Hope you have a great rest of the week, and at the latest, I'll be back midweek next week. Take care. Bye-bye.